Welcome everyone to the latest episode of Knight Frank's Property Perspective, where we discuss all things property, both direct issues in the market and also issues impacting the market, whether they be economic, financial or otherwise. Today we've got a really interesting topic as we discuss the implications of the tariffs announced by the Trump administration several weeks ago, talking through what has happened and what it all means for property. I should caveat by saying we're recording this on the 1st of May. By the time some of you listen, things may have evolved, and we'll, of course, keep in touch on all of these issues. I'm joined today by a couple of colleagues with some really interesting perspectives. I'm joined firstly by Alistair Read, who's joined us recently as a senior economist in the research and consulting team, and also by Adam Fairfax, who joined us recently as a partner in our institutional sales team. Welcome, Alistair. How are you?
Yeah, good, thanks. Looking forward to an interesting podcast ahead.
Absolutely. And Adam, how are you?
Very well, thanks, Ben. Thanks for having me on. Looking forward to it.
Well, we've got a great topic, certainly very topical. All of our listeners, I'm sure, will have been following the news over the past few weeks. We've seen some very important announcements coming out of the Trump administration in the US and significant market impacts, all relating to tariffs, of course. So can you fill us in a bit, Alistair? What sort of happened initially and how has it evolved over the past few weeks?
Yeah, absolutely. So the policy we've seen, there's been three main impacts that have come through. So the first one we saw was build-up of the North American tariffs. So that's between Canada and Mexico and the US. The second one we saw come through is that baseline 10% tariff across all countries. And then the third one, which really caused a lot of issues in markets, was the reciprocal tariffs. So that was the different varying rates across countries. They've been paused for 90 days through to July 9. But the big one that stuck out that really markets are still concerned about is the rate between China and the US. So currently the US has 145% tariff on China, and China has 125% tariff on the US. And that's, even though the other one's put on pause, that one still remaining in place is really a big issue for markets.
And that's a pretty big number, 145%. So, I'm reading that that's going to result in some industries, a virtual cessation in trade. So that's obviously pretty significant. And while the administration's keen to put forward the view that, this is a cost to foreigners, of course, ultimately tariffs are going to be paid by the end purchaser in the United States, whether that's a consumer buying the goods directly or whether it's a business using those goods as an input to other production processes. So significant costs to the US and some downside risks to growth. I mean, it's a bit early in terms of hard data, but what are we seeing in terms of sentiment indicators and, expectations changing for the US?
Yeah, absolutely. We've seen the tariffs have quite significant impacts across a variety of indicators. So the first kind of hard bit of data we've had come through came out last night. So that was US GDP, which in quarter one was down 0.3% for the year. And that's the first decline we've had in US GDP quarterly since about 2022. So in terms of the growth impact, we're starting to see it come to the US, but we're starting to see it really impact sentiment over the last month. So if you look at stock markets, I'm sure we're all aware of the significant volatility we saw in stock markets. Through some of the surveys we're having for consumers and businesses, their sentiment levels have declined quite strongly. And the issue of that is that it really drags on decision making. So uncertainty stops businesses and consumers making decisions around investment, and that's how it's flowing through to have global growth impacts. So a week ago, we saw the IMF come out with their global growth forecasts for the April quarter, and they've changed quite significantly since what they did in January before the tariff impacts came out. So world GDP has been pushed down quite significantly, about 0.4% down since a couple months ago before the tariffs. And also the tariffs are going to have their largest impact on the US. So the US is really the outlier in terms of significant negative impacts of the tariffs. And that's going to have quite a negative impact for consumers' investment there. But it's also going to radiate out towards different countries. So China, as I mentioned before, quite significant tariffs against it, and that's going to slow down their growth as well. And that's how we see it flowing back through to the Australian economy.
Indeed, I think sort of raises a number of questions, probably not directly for us in the same way that it's going to directly impact other countries, but indirectly in terms of impacting the growth outlook. And we'll have to wait a while, of course, to sort of see where the data lands. I mean, you allude to the contraction in GDP, which isn't it's Q1, so it's sort of before the tariffs were announced, but it was impacted by a lot of purchasing activity in March, which people could see it coming, and imports certainly spiked. But yeah, the hard data will take a while to come through. But on financial markets, of course, we get daily indicators for a lot of different asset classes, and equity markets took a big hit initially. Adam, you're a great experience in equity markets. How have you sensed it over the past 4 weeks? Very interesting.
Thank you, Ben. Look, it has been an interesting 4 weeks. It reminded me somewhat of COVID and probably somewhat of the GFC before it. It was a pure panic period, and frankly, you could see that with a thing called the VIX. The volatility index really shot up, and that VIX volatility index was higher than it was during COVID. It was headed toward the sorts of numbers we saw during GFC at a point, which is just really sheer panic. But ironically, such is the volume of money in the equity markets and the will of people to make it to continue to go up, that it has largely shrugged it off. So if you look domestically and in the US combined, each of those range traded within 25% within 3 sessions of the news on the 2nd of April. The Aussie market by the 7th of April had lost 9%, and that's just pure price. But I looked this morning, conscious that today itself has been a strong day, but today the Aussie equity market is 2.4% ahead of where it was pre-tariff level, which seems not believable, but it genuinely is. The S&P 500, it lost 12% by the 8th of April, so within 6 trading days. Today, it is within 1% of that pre-tariff trade level. And ironically too, the NASDAQ, which is something that was affected at the start of the year by the China DeepSeek and the Magnificent Seven being declined, that fell 12.5%. It's closed today, or last night, should I say, at that same pre-tariff level. So all 3 major indices that we are relevant for us are at or above the levels that they started at. The one probably more pertinent to this conversation and the listeners thereof is the REIT sector. The REIT sector is clearly the Australian listed property trusts. They lost 9%, and that is a sector that is today 2.4% higher, albeit over the course of today, a stock that makes up 40% of that AREIT index, which is Goodman Group, is over 4% today. So you're going to see the AREIT sector up 2.5% odd today alone.
So do you mean, are we up then, are we sort of, for both the REIT sector and the equity market overall, or are you effectively saying we're back to where we were in March?
The AREIT sector, the S&P 500 and the equity market, the Aussie XJO X200 are all at a level at least or higher than where they were before the announcement of the tariffs. And I would just add to that too, Ben, overnight, one of the things that really drove it, or one of the things that we're starting to see, is this pragmatism by the US government, whoever it might be. But it was Besant overnight that said that there were trade deals imminent with India and Japan, and he characterized the US-Chinese trade war as quote unquote unsustainable. So the early, significant comment about everyone's getting a tariff seems to be wound back, and equity markets are responding quickly.
They are. I think they've bounced back more quickly than we would have expected. It reminds me of March 2020, of course, we saw a bigger fall, a bigger event with the advent of the pandemic. But of course, we did see markets, bouncing back pretty quickly, even though lockdowns had sort of barely commenced. We were seeing, a pretty strong rebound, recouping some of those early losses. So, again, we've probably been surprised by the speed of the rebound, but there's conflicting indicators in different directions. So that sort of sounds like there's more comfort has been gleaned from, recent noises coming out of the administration. I mean, I hear that they're not actually in touch with China though. So, some positive soundings on the one hand in terms of those stated comments and reassurance that there's a few trade deals in the works, but the big one in terms of their negotiation with China that hasn't advanced. But then look, other indicators as well, like the gold price, Alistair. I understand we're sort of going through the roof there, which would suggest more of a risk off sentiment there too.
Yeah, absolutely. The gold price has been rallying since the start of the year, and the recent events has only just made it rise even further. We've seen it come off from record highs earlier in the year, but it's definitely risk of sentiment at the moment, where people are really going towards assets they know well.
And the exchange rate, another one where we saw again immediate falls, but just as you've outlined in the case of the equity market, Adam, we've seen a pretty strong comeback, which is probably less to do with the strength of the Australian dollar and more to do with a sell-off of the US dollar, which is not something that we would typically see in a period of turmoil. But of course, we are in these are unprecedented events. We're going to come on, of course, to talk through the real estate impacts. Of course, it is early days, and it takes longer to gauge the impact of these things on private markets compared to what we see in listed markets. But before we do that, it's worth talking about the other element, which of course is key to the outlook, and that's the interest rates. That was key to the outlook before this. But so you want to just outline there, Alistair, what we've seen in terms of a change of market expectations?
Yeah, absolutely. So we start off with the Australian market. So we saw when the initial impact of tariffs happens that a lot of commentators are quick to call for a large reduction in interest rates. Some people have called for emergency meetings, the RBA, to reduce them quickly, but we're seeing that wind back quite a bit as we've seen some of the tariffs come off and sort of the US slowly step back from some of the tariffs implemented with some exemptions. So Australian interest rate is currently at 4.1% at the moment. Recently, market pricing has it at around 2.9% by end of 2025, which is about 1.2% lower than where it currently is. At the moment, for May, we've got a 25 basis point cut priced in completely and about a 50% chance, according to the market, of a 50 basis point cut in May. So coming this year, the US tariff, all it's done is just brought forward the interest rate cut cycle to what it would have been before the tariffs. Some other economists, they aren't quite as optimistic as markets. They're sort of seeing around 3.1 to 3.35% interest rates by the end of 2025. There's a bit of uncertainty over where they'll end up, but the profile is definitely down.
Indeed, definitely down. And look, it was probably, there's never a consensus, of course, entirely around these things, but to the extent that there was some commonality of view around sort of thinking it'd be more sort of 2 to 3 cuts in the cash rate, or at least that was the view in February and March from most. It's never all, but now it's probably, as you say, more like 4 to 5 as being the market expectation. Adam, I think your former colleague Sally Auld has been very well regarded chief economist now at the National Australia Bank. I mean, she probably took the view that it would be a bit more than that.
That's right, Ben. She's come out quite aggressive. It was probably 2 weeks ago now, so probably at the height of the fear stage of this situation. And that's not to say that it won't go away, but she's calling for 50 basis points in May. And then she's got 25 basis points in July, August, November, and one again in February 26. So she's calling for 150 basis point cuts or 6 interest rate cuts. And I've got to say, looking at the equity market, looking at the commercial real estate to a lesser degree, but also the residential market, you'd have to say that they will all get a significant shot in the arm if that is correct. I don't actually agree that we'll see that quantum of cuts. I'm probably more in the camp seeing consensus tightening up around a May cut, but certainly 2, if not 3 after that as a maximum.
Indeed. Look, as you say, it's a definite shot in the arm, whether it's, I think we were feeling that it would be a shot in the arm even when market expectation was more along the lines of 2 or 3 cuts. But obviously 4 and 5 would be more significant, but then it's offset by the uncertainty around growth. I mean, of course, were we to see that, it would be for a reason, which is because there's clouds over the global outlook. And that impacts real estate as well. But, we are one of the more interest rate sensitive parts of the economy. And so a significant silver lining. Investors will be looking at the potential upside that they would get from a lower cash rate feeding through and sort of potentially feeding through. And there's the uncertainty around the extent to which it will feed through to lower long-term rates. But it's certainly not going to push them up, at least not in Australia. So it's helpful. But on the other hand, some of the uncertainty will be impacting on decision-making as well. So, I know you've been taking early soundings, Adam, within the investor community. What's the mood out there?
Yeah, look, it's a good point you raise. I mean, we do a lot of meetings with, listed investors and wholesale investors and intended investors domestically and abroad. And I would sort of loosely categorise the groups that I've spoken to into the REITs, wholesale investors and private investors. If I was to start with the REITs, I would say that the starting point for a listed real estate company in Australia is that the gearing level of that company is toward the upper band of their comfort level at present. that means that if asset values are devalued, then that becomes a little bit more painful for them. So what I've noted in meeting all of the large REITs is that if we're going to buy an asset or do a development or look to do a JV or of some description, typically speaking, either A, they want to sell an asset to fund that, or two, they will use cash on balance sheet. But given the the move that we saw in the equity markets as a result of this tariff news, and let's not forget it was 9% for REITs in just a few trading days, they're less likely to use equity. And as an example, actually, Goodman Group raised $4 billion just a couple of months ago at $33.50. That stock traded at $25. And that is one of our better quality, more capitalised stocks. So, there's this reticence by REITs to use equity capital. On the wholesale side, I would suggest that the general view of wholesale investors is that they are looking to raise capital domestically, but also abroad, and particularly leaning on this Japanese capital that we keep hearing about and reading about. The interest rate differential clearly between Australia and Japan has made us a very, very attractive investment place for them, and we've seen some large-scale transactions happen. So I would say that the wholesale capital pool is looking more to Asia for funding. And then if you look at the high net worth group, which is not insignificant, and the private equity, you're starting to see reasonable licks of money being used for opportunistic and value type investments. And by that, I mean build to rent, build to sell type product. And also we're seeing, these sorts of private groups looking in Melbourne at commercial and the like.
Indeed. You raise a good point there in terms of a more direct impact on activity of the listed groups. I think we've seen for some time, over the past couple of years, it's been a quieter market overall because we've been going through a downturn in some parts of the market, and there's uncertainty over where values would end up. I feel like we were coming out of that process. We were starting to see a bit more activity, and I know you put some numbers together on that. Alistair, what were we seeing in Q1, sort of pre-tariff announcement in terms of liquidity levels in the market?
Yeah, absolutely. So coming into Q1, so I guess in 2024, we saw transaction volumes showing some modest improvement, and that momentum continued through into Q1 2025. It is important to note, that largely amidst the tariff impacts. We haven't had that many transactions since the tariff impacts happened. But an important pull out of that data is the office market. So the office market performed pretty strongly in Q1 with the highest Q1 sales volume since 2022. So it's interesting as well that about 80% of those acquisitions came from cross-border capital, which is quite a shift from what's happened in previous years. If you look at where the capital's come from, I guess in 2024, we saw private capital was really the strong buyer in the market for Australia. They're more opportunistic, more willing to buy in a downturn, and they really have generally a higher risk tolerance. But what we saw in 2024 is the institutions started to come back into the market as uncertainty really started to clear about the direction of interest rates, and we had some transaction evidence that made it more certain that the market was near the bottom. Moving into the start of 2025, what we've really seen is that private capital has fallen in terms of acquisitions, and cross-border investment has risen, but institutional sales remain at a stronger level. So the faster decline in global interest rates has probably been quite a driver of that cross-border capital flowing into the Australian market. But it's going to be interesting with these shifts that are happening and the increased uncertainty whether institutional investment is still going to stay strong this year.
Yeah, I think we were seeing. So I think some of the forces you mentioned reflect more of a normalisation, I would call it. So we'd seen less institutional participation, less participation from offshore institutions in particular over the past couple of years as we worked through the interest rate hiking cycle and the devaluation cycle. I think we were coming back to a more normal situation in terms of higher transaction volumes and a more balanced mix. But I think this raises the question whether that whether it'll just now take a little longer for that rebalancing to play out. What do you think, Adam, in terms of both the buyer mix, but then also those who we do see active? What are they targeting at the moment?
Yeah, that's a good question, Ben. That's something we're really interested in knowing too. Obviously, with our business looking for helping capital find real estate homes, and it's quite clear to me in just the sort of 7 weeks that I've been talking to people on this The first one, in no uncertain way, is convenience retail. We have 3 or 4 groups, including groups in Asia, looking to add to convenience retail shopping centre portfolios, either from a base of not owning assets to acquiring multiple assets or adding to existing portfolios. And then we have portfolio remixing within that as well. And also within that retail convenience space, we've got a lot of optionality around developments as well. So people looking for greenfield and brownfield development sites within that. Outside of convenience retail, we've got core CBD office in Sydney and in Brisbane. You could certainly find a lot of capital for that asset class now in Sydney and Brisbane. And that's because it was perceived and has been perceived that office, because of working from home and these sorts of things, that there was a sort of a latent sort of value within the sector. We've seen some landmark deals occur in Sydney, be it 10 to 20 Bond Street, be it 135 King Street, be it 55 Pitt Street, where big licks of money have come in to buy quality assets. It's also been amplified by virtue of the fact that Melbourne is largely off the table because you've got this foreign owners tax. And we learnt that more so when we were offshore, but also domestically, that to invest in commercial in Melbourne sort of amplifies the demand that we're seeing in Sydney and in Brisbane. Outside of that, Ben, just quickly, storage assets are very attractive at present. They always have been. They've been niche, but we're seeing institutional demand growing. So we've seen Public Storage, a US REIT, enter the market with KI Corporation, and KI Corporation is the part owner of the Abacus Storage King portfolio. They're looking to mop up the Abacus Storage King portfolio to take that private, and as a result of that, the alternative storage REIT in Australia, National Storage REIT, has taken a 5% equity stake in that REIT so as to have a seat at the table to negotiate an outcome, presumably a higher price, presumably a carve out of assets or something else. But certainly storage M&A has attracted international capital, and also within that we have spoken to REITs in Australia and others that are looking to get into storage. Of course, and it's not new news, build to rent and build to sell apartments are certainly hot to trot, particularly Asian capital, certainly German capital and local capital, with the caveat being finding sites with DA or planning approval is really hard to get. And as a sort of an adjunct to build to rent and build to sell, ironically, and something we haven't seen in a long time is increasing questions on and demand for international hotels in and around Sydney.
As you said there, Adam, growing interest in alternative sectors, including hotels, which is a space we haven't seen very active in recent years, but just as we've seen a pick up in immigration driving overall population growth, we've seen strong tourism flows coming into that sector, and the improved performance in the occupational market feeding through to increased investor interest across a number of sectors. I think, as you've said, we see rising interest in both the alternatives in the traditional market as well as you outlined, Alistair. Lots going on in the office market. I think we don't know what's going to happen with tariffs. We don't know what happens at the end of the 90 days. I think we can take some comfort that there's been a stepping back, both in terms of the rhetoric, but also tangibly in some accommodation and carve-outs being emerging in recent weeks. So one would hope we'll continue to see that as the realisation around the potential negative impacts cause some pulling back. Markets are, I think, poised for a gradual recovery. It won't all be at one pace, but I think as you've outlined, we've got improving fundamentals. We've been through the worst of the interest rate hiking cycle is now definitively over, and we've come through the devaluation cycle, and so with an outlook for growth, which is what people will be eyeing in the long term, even if the short term will remain uncertain. I think we'll leave it there. Lots going on, and as events evolve, no doubt we'll have more to discuss in coming weeks on these issues. But thank you for listening, and we'll end it there.
Before you go, subscribe to our channel so you don't miss out on the next episode of The Property Perspective, when we'll be back to share our take on more key trends and topics shaping Australia's property market. You can also follow us on LinkedIn or visit our website at knightfrank.com.au for more information. Thanks for tuning in. It may be the end of the show, but we're always your partners in property.